Well, good morning. Welcome. On behalf of everyone at California Wealth Transitions, thank you for joining us this morning. The webinar will be up there for, the poll will be up there for another second, and then we'll start our program. This is our first webcast since California Wealth Transitions and PSM Private Wealth merged our firms on the 1st of July. We consider July 1st to be a shining moment for our firms since we were able to complete the merger in the midst of some very difficult circumstances. We also consider July 1st to be a special day for you, our clients, because you now have access to a much greater depth of knowledge and wisdom and expertise, plus a greater degree of security, knowing we've got multiple talented advisors that are available to help you. Today, from the poll, I can see we have a few Democrats as well as some Republicans. I'm sorry to disappoint you, but we are not going to tell you who's going to win the election. But we do hope to share some thoughts and ideas to help reduce your stress a bit about the impact of the election on your portfolio. A little bit of housekeeping. During the webcast, the speaker will be talking. No one else will be able to speak. If you have a question, you can submit that using the Q&A button on the bottom of your screen. If we have time, we'll address those questions at the end. We're fortunate today, once again, to have Tim Miller from BlackRock with us. Tim is a director with BlackRock, and as you know, BlackRock is the largest money manager in the world. Tim, all yours.
All right, Keith. Well, thanks very much for inviting me to participate today. And just give me a quick confirmation you can see the screen. Okay, great. Well, Keith, Krista, Blake, Janet, the entire PSM and California Wealth Transitions team, as well as everybody who's had the opportunity to dial into this webinar today. I just want to say thanks for making the time. Thanks for inviting me to participate. And we find ourselves in interesting times yet again. If you were to go back to the start of 2020 and look at all the outlooks written by all the different major investment firms, undoubtedly the lead story of 2020 would have been the election, which hasn't even yet to take place. And of course, coronavirus, to do a little bit of a play on words, said, hold my beer. And we're going to have a bit more to talk about in relation to the virus. So I've called this presentation the Four Horsemen of the second half of 2020. And we're going to talk a little bit about the public health and the coronavirus pandemic, because it's something that very much we're still living with. We're going to talk a bit about China trade tensions between the United States and China, the response that we've seen from policymakers, but we're going to spend the majority of our time talking about, of course, the election, because that's what I think everybody is on everybody's mind. So just a quick assessment as to where we are through the first half of the year. And actually, this is through yesterday. The S&P 500 is up 6%. Mid-cap stocks are down 7%. Small-cap stocks are down 13%. So there's been a big skew to large-cap companies, and in particular, technology companies. Growth companies are up 20% this year. Value companies are down about 10%. And of course, the technology sector is up 24%, leading the way for large cap growth. International markets are flat to slightly down. Emerging markets are up 1%. International developed stock markets are down 4%. The core fixed income markets, defined by the Barclays Aggregate Index, is up 7%, and corporate bonds are up about 8%. But of course, one of the big stories this year is a story that I think we're going to live with for years and years to come, which is interest rates are back at zero. The 10-year Treasury started 2020 at 1.92%, and as we sit here and talk today, it's at about 70 basis points. So we've lost about 2/3 of the income of U.S. Treasuries writ large, and income's going to continue to be a challenge for years to come because of the Federal Reserve's policy going forward, which is to keep rates very low. They actually just announced yesterday or the day before that they don't expect to raise rates on the benchmark Fed funds rate until potentially 2023, which is a long time from now. So we're going to get into this, but let's just get right into the virus so we can so we can get to the topic that everybody wants to discuss, which is the election. So COVID-19 is going to continue to be a focal point in our country and driving our economy to a certain degree. And as you can see with this chart on the right, the United States has seen over the summer this spike in cases. And at BlackRock, our belief is this is in part due to the fact that perhaps we reopened economies in certain parts of the country a bit earlier than we might have otherwise, of course, with the benefit of hindsight. But I think it also owes to the fact that we're doing a ton more testing today than we did in the earlier part of this pandemic. And the United States leads the way in testing with having conducted 70 million tests, which is significantly more than any other country. Russia is second with half the number of tests that we've conducted at about 32 million. And our belief is more tests equals more positive results. There's been some talk of a shutdown 2.0. We don't think that that's very likely. In fact, what we think is most likely is how we're all living today, which is doing our best to remain socially or physically distant, wearing masks in places that previously we might not have, no indoor dining or limited indoor dining, limited outdoor large crowds, like 25% capacity in much of the country is what we're living with right now. But not to be missed here is we believe the worst of the data from an economic perspective in terms of things like unemployment, GDP numbers, we think the worst of that's behind us. The only other point I'll mention on the virus before we move on is there's a big question on people's minds. What's the shape of the recovery? Is this a V-shaped recovery? We've heard Nike swoosh. We're not going to spend a ton of time on this, but for the reasons that we've mentioned above, we saw a 33% decline in GDP, and we're fairly certain at this point, at BlackRock anyway, that the U.S. economy is not likely to come back at a rate that would indicate a V. The stock market suggests otherwise, and we're going to talk a little bit about that later on, perhaps even in Q&A. But history might very well show us that the decline took place only over the course of 2 to 4 months, but that even the most optimistic expectations of GDP growth coming out of this have us reaching year-end 2019 GDP levels, perhaps well into next year, 2021. And at BlackRock, we're calling for the reattainment of 2019 GDP levels as Q4 of 2021. So at BlackRock, our belief is it's going to be more like a check mark than a V. So moving on from that, we're going to talk about the policy response. I know it was kind of the fourth topic on the Four Horsemen, but we're going to rearrange some things here. And I'm not going to spend a ton of time on this other than to say that the policy response has been tremendous. The Federal Reserve and Treasury have injected something on the order of 5 times the stimulus into the economy than they did throughout 2008 and 2009. So it's about $1 trillion then versus about $6 trillion earlier this year. And that's before you even consider any further stimulus that we could see later this year. And one other note on that, as every day that we get closer to the election, we believe at BlackRock it's less and less likely that there will be a round 2 of stimulus prior to the election. And so at this point, we're not really counting on that happening, but rather, depending on who's elected, potentially a round 2 of stimulus after the election. In any other year, U.S. China trade tensions would be the lead story. But this year, of course, they're like second page news. But whether it be because of where the pandemic originated and Trump's penchant for kind of blaming China, we think that U.S. China trade tensions are here to stay, frankly, regardless of who's elected in November. If Trump's elected, we suspect that his course of action will be much like what's taken place in the first term. And if Biden's elected, we expect a bit more of a traditional diplomacy approach, and one that would likely be characterized by forging alliances with our developed country brethren in places like Europe, Japan, and South Korea, and creating a bit more of a united front. But make no mistake, supply chains are already starting to adjust to this dynamic. and the decoupling of the two largest economies in the world, and the rivalry between not only the United States and China, but kind of China and the rest of the developed world from an economic perspective is likely to persist for years and years to come, perhaps even beyond this next 4 years, regardless of who's elected. So with the virus, the policy response in China kind of out of the way, those were the appetizers. The main course, of course, is the election, which is just about 45 days away. And we're going to talk through some of the scenarios playing out. We've got them here on the screen right now. And then we're going to talk about some of the finer topics, and we'll close with what we might do about it. And before I even get into the scenarios, let me just say a couple of things that need saying before we talk politics. Number one, this is a very uncertain election. And we talked about this earlier this year when we did a webinar with your clients. At the time, we actually did two separate. We did one with California Wealth participants and one with PSM participants. But the message was similar in that uncertainty, when uncertainty levels are very high, individuals naturally seek out certainty. We want firm answers when things are most uncertain. And that is almost precisely when firm answers don't exist. And whether it be the early days of the pandemic, that term that statement would apply, but it also applies here on the eve of the election, or as we approach the eve of the election. And the other thing I'll say is this: predicting political outcomes is very difficult. Predicting financial market outcomes that result from unpredictable political outcomes is even harder. In fact, as I say it, you can start to probably even feel how difficult this would be if you're in a position of trying to make investment decisions around this. I think of it like uncertainty squared. And also, before covering the scenarios, I also want to address just a couple of other elephants in the room. It's quite possible that this year, election day turns into election week or election month. It's possible that due to the politicization of the COVID-19 outbreak, Republican voters will largely vote in person, while it appears that Biden supporters may see a combination of in-person voting, but also a large population of individuals voting by mail, which could end up taking longer to tabulate those votes. And what this could mean is that on election day, it may end up appearing that Trump wins the election, while a couple of days or perhaps weeks later, after more of the mail-in votes being counted, it's possible that Biden wins. With the polls where they are today, it appears that Biden is going to win this election. The kind of uncertainty around our election process that could come from a delayed result certainly would spell, we think, some volatility for markets, because markets don't like uncertainty. And so we would suggest to you to expect perhaps a period of short-term volatility, either leading up to and perhaps even following the election. And we would suggest preparing for it. The best way we think you ought to do that is by having a conversation with your advisor at PSM or California Wealth Transitions to discuss really two things. Number one, your risk tolerance and your asset allocation. And then number two, and this is just as important, the asset allocation that's needed to reach your long-term goals. At the end of the day, we're talking about a period of time in American history that will come and go in about 90 days or less. But by my suspicion, most of your investment goals have a term that is much longer than 90 days. Unless there is a landslide in one direction or the other, such as an early call in Florida of a significant Biden win, again, we think investors should prepare for disruption around the election, potentially around the delayed result, and potentially even having to call on congressional resolution of some of the disputed electors. So, and the other thing we think people should expect, considering what's at stake, is if there's a dispute each candidate, in fact, both candidates are already amassing like armies of attorneys to pursue every legal and procedural route possible to victory. I think it's safe to say that Trump is likely to declare an early victory, and it's possible that he may end up winning the election after all. But you can almost count on the fact that if we see kind of a red mirage and rather a red wave and a blue mirage, you would almost certainly see Trump declare victory early. The other thing that I think we'll call out before talking about some of the scenarios is in the year 2000, where there was a delay in the final calculation of the result. It only involved one state, not potentially multiple states. And the country, I think it's safe to say, is a lot more polarized today than it was 20 years ago. We don't have the same social media environment today. In fact, we have a much more robust one today than we did in the year 2000. And as it comes with it, as we found, some degree of disinformation. And political discourse was a little more palatable in the year 2000. And also, neither Bush nor Gore gave any indication that they would not abide by the results. And so it's just shaping up to be a very difficult one to handicap from an investment perspective. So with that being said, let's talk about some of the scenarios. And we've laid out all three of the main scenarios as far as the actual outcome on the screen here. So we call the first scenario the blue wave, and this is where Democrats win the White House, the Senate, and maintain control of the House. This outcome probably produces the greatest degree of political change, potentially starting with the reversal of Trump's policy agenda on many fronts, including taxes, immigration, and regulation. And we're going to spend a little bit of time on this one. One result that's been talked about a lot is either a partial or a full rollback of the Tax Cuts and Jobs Act of 2017, which obviously included big tax reductions. And what's been proposed is increasing the corporate tax rate to 28% from where it is today at 21%. And of course, the reduction in taxes from 35 to 21 provided a major boost to corporate earnings. And so even a partial reversal of this, we suspect could have the opposite effect, which could prompt investors to take that into account when estimating overall corporate earnings outlooks. But that said, we believe there's a bit of a sanity check that goes on before even suggesting a tax increase. In other words, how strong is the economy? And we don't think it's necessarily safe to assume, full stop anyway, that a blue wave scenario automatically results in corporate statutory rates going to 28% or foreign sourced income going to 21%. The big question will be, can the economy take it? And immediately on the eve of the election, or I should say the day after the election, whenever it's decided, the answer is almost undoubtedly no. The economy cannot take a tax increase on the back of COVID-19 in this election. Before you draw a conclusion that I looked at the polls and it seemed like there are more Republicans on this call than perhaps Democrats. Before you draw a conclusion that a blue wave or even a Biden presidency would be bad for the economy, it's actually possible that a Democratic sweep results in significantly higher government spending, to the tune of potentially even 5 percentage points added to GDP by our calculations. And when combined with positive vaccine development, so big government spending combined with what we expect to be a fourth quarter announcement around a vaccine, this could actually pave the way for a pretty nice economic recovery starting in 2021. With Biden being elected, we'd see a lot more spending from the government and likely a much looser policy on immigration versus Trump. And I think the immigration piece is kind of interesting right now from an economic perspective. And, just bear with me on this. If you're thinking classically of the how to calculate economic growth at a macro level, it's labor supply plus investment with some calculation or allowance for productivity growth is how we get to economic outcomes. And so with Biden's likely increase to investment, more so than potentially we would see out of Trump, plus potentially greater immigration, it paves the way for a greater economic growth picture than maybe a lot of Republicans would otherwise believe. With the Trump administration, there's a decent probability for some investment, but probably a greater chance of greater investment with Biden, especially around things such as climate change. There's a little bit more certainty under Biden than under Trump in that regard. Scenario 2, we would call gridlock. Biden wins the White House, Republicans maintain control of the Senate, and Democrats maintain control of the House. We call it gridlock because it would be very difficult to pass major legislation. You would see Senate Republicans block major Democratic initiatives, a lot like they did during the second half of the second term of the Obama presidency. And I think in this case, we would see Biden governing through executive orders. There would be a ton of frustration in a gridlock scenario. And I think it's at this point, it's probably an easy outcome to predict, but not an easy outcome to live with. And then scenario 3, we would call status quo because it's what we have today. Trump wins re-election, Republicans keep the Senate, and it probably involves the least amount of change, at least from where we are today. The House, we think, is likely to maintain or remain in Democratic hands. So regardless of who is in the White House in January, we think there's going to be a lot of post-COVID-19 cleanup work to do. And we would say in 2020, especially the second half of 2020, we're kind of in stabilization mode, and we're going to be moving into recovery mode in 2021. Now, I think there's a couple of other comments to be made before closing out the topic of the state of our country and the election and the debt and the deficit, which seems to be kind of running away. There's a lot of questions about this and how it will be handled, especially with Biden's economic plan, which I want to say adds $5.5 trillion to the deficit in the next 10 years. There are essentially 4 ways for governments to rein in debt as a share of GDP. Number 1 is default. Number 2 is to increase GDP. Number 3 is austerity, which is cutting spending, raising taxes, or some combination of those two. And then number 4 is what we call financial repression, which is keeping interest rates below the level of inflation while generating some growth. And of these 4, 2 and 4 seem like the most likely options. In other words, raising GDP through a combination of corporate economic recovery and government investment and spending, and as we've heard in the last month or so from the Federal Reserve, keeping rates low and moving to this policy of average inflation targeting, which means that we want inflation to pick up, especially in excess of where interest rates are. And if we assume a positive GDP boost from a combination of government spending and immigration, a Democrat presidency and potentially even a Democratic sweep could mean more growth and financial repression, whereas a divided government under Trump would likely have to rely more just on financial repression as opposed to just like something coming from a big increase in government spending. The last thing I'll hit on is just this well, you know what? I'll leave that for Q&A because I think that will be a question, is the disconnect between the stock market and the economy. But we get this question as well about, like, what is the long-term outcome? And the reality is, in our economy, regardless of Democrat or Republican control, the stock market has done well over longer periods of time. What is undoubtedly the case, though, is that people get nervous in election years. And so what you end up seeing on the left-hand side of this chart is the increase in deposits into money market funds in election years versus non-presidential election years. In other words, election years in orange, non-presidential election years in yellow. And we've seen that to a large degree this year. I think what accounts for the even larger increase this year is the fact that we've also had a pandemic and a tremendous amount of volatility earlier this year, which also leads to large increases in money market flows. Over time, you end up seeing slightly better returns in presidential election years versus, say, the broad history of U.S. stock markets. And so far this year with stocks up 6%, I guess you could say we're on track for that. Although, as we all know, it's been anything but a normal year in the stock market. The last couple of things I'll hit on before opening it up to questions are a little bit more on money markets. So right now we're at just under $5 trillion. And in the previous time, I should say periods of time when we've seen large increases in money market fund deposits, it's ended up being a very good time to invest in stocks. As you can see on the right-hand side of this chart. Following 03, you saw 16% annualized returns. Following 09, 19% annualized returns over the next 3 years. Back to that conversation about goals. A big conversation that should be had, if it hasn't already, and I'm sure it has with the advisors at PSM and California Wealth, is around rebalancing. If you started 2020 with a 60-40 portfolio, by the lows in March, it ended up being about a 50-50. If you rebalance back to 60-40 on or around those lows, that means you had more equity buying power to recover in the recovery that we've seen since then. We would suggest bearing this in mind if we see volatility coming into the election or around the election. Rebalancing also works both ways. So if the recovery has gotten you out of whack to say 65 or 68% in equities, maybe you think about rebalancing now on the eve of what might be a volatile environment in equities. And then the last thing I'll hit on is this. Over the last 5 years, if you invested in individual companies as opposed to diversified funds, you ended up having about a 50-50 chance of making money. If you were diversified in mutual funds and or ETFs, you had about a 93% chance of making money. And I mention this because there's a greater and greater interest in investing in the individual companies, whether they be technology companies, biotech companies, or the like. And it's not that we think it's a bad idea, but your odds just go down in terms of making money over longer periods of time. And so think about all of this. And with that, we could go on a lot longer, but I know we wanted to leave some time for questions. So with that, Krista, I would be happy to turn it over to you to see if there are any questions from you or from the group.
Okay, great. Hi, everybody. For those of you who don't know me, I'm Krista Murray. And my partners, as Keith mentioned, my partners and I merged our business with California Wealth back in July, and we're delighted to be working alongside the California Wealth team. First, Tim, thank you so much for the informative presentation. They say knowledge is power, so we all feel a little bit more powerful now. We do have some questions from the audience. We won't be able to get through all of them today, so if your question was not answered here, please follow up with your advisor who will be happy to address your concerns. So first from the audience, you had mentioned the stock market disconnect, that the stock market seems to be doing really well, but we still feel that the economy is quite wobbly. Can you address that?
Yeah, so there's a pretty obvious disconnect right now between the stock market and its earnings and the U.S. economy broadly. And, I think the biggest sectors in the stock market aren't necessarily going to be the biggest sectors in the economy. So in other words, technology today, even with some of the technology companies being pulled out of the tech sector and put into communication services like Google or Facebook, technology represents about 30% of the S&P 500, but it's very likely not the case more broadly in the economy. And I think the coronavirus pandemic has created something of an accelerant to these sectors, technology, e-commerce, social media platforms, which in turn has supported their earnings growth even further still. So I think that's why we've seen what ends up being somewhat of a narrow market coming out of the pandemic, and why we also see the S&P 500, which is dominated by a lot of these companies, up 6%, mid-cap companies down 7%, small-cap companies down 13%. The second point is, and I think this is where the stock market and the economy kind of come together, is that the stock market likely doesn't do as well as it has without the stimulus that we've seen. Incomes, broadly speaking, in our country have held up fine because of how massive the fiscal relief measures were to bridge household and corporate cash flows. And without that taking place, we don't think that you see anywhere near the recovery in the stock market that we've seen. And frankly, that also presents a risk. Is right now we are on the eve of a lot of these stimulus measures kind of waning, and what kind of wind is in the sails of the broad stock market today versus say 6 months ago, when we were just throwing trillions and trillions of dollars at the problem. But our money is still on maintaining a slightly pro-risk stance today. And that comes back to the fact that the Federal Reserve's monetary policy is still at 0% and will likely remain the case for years and years to come. And when you think about this and rates being as low as they are, any time that the Fed has been this accommodative, it's made a lot of sense to continue to maintain investment into equities. And over time, what we see and what we expect is that the U.S. economy, frankly, to catch up to the U.S. stock market as opposed to the other way around, the U.S. economy necessarily leading the stock market. So, yes, there has been a disconnect. It owes largely to how big the stimulus was, and the continuation of it going forward is going to be dependent on continuation of corporate earnings growth combined with continued easy monetary policy, which we'll have for years and years to come.
Okay, thank you. Can you give me a short response as to why it seems to matter so little to the market in the long run who is in the White House?
I think that's kind of the beauty of our economic and political system, and is whether it's President Trump, leading up to the pandemic, President Trump took plenty of credit for the economy, even with the recovery from around 20% unemployment to where we are today, around 11. President Trump takes credit for that as well. But you saw this happen in the late 90s with Clinton on the back of the strong economy in the 90s. And the reality is the American economic system is such that it really doesn't matter much who is in office. Certainly policy matters, but American companies have demonstrated a tremendous ability to address changes in policy with their business practices. And over time, what you're getting ultimately is access to the growth of these companies. And what can present challenges over shorter periods of time are things like changes in tax policy to the negative on the corporate side. And that's one potential headwind coming into a 2021 if we saw Biden win. But over time, the American economy is largely independent of American policymaking, and certainly they can move together, but American economies tend not to be as influenced by American politics as individuals like to think, and as they certainly vote. And so we just don't think that people need to be making decisions with their investments solely on the basis of who they think will be elected 45 days from now, or between now and the end of the year, if it's longer than that. And mainly because we've got plenty of lessons in the past of why that hasn't made sense. For example, if you were a Democratic voter in 2016 and you were scared to death of Trump being elected president, which ended up happening, it ended up being a pretty bad idea to move your investments to cash, for example, or to take risk off the table just because President Trump was elected. And we think the same will end up being the case if, in fact, Biden's elected. By policy, is he as pro-business? Perhaps not. But businesses have demonstrated creativity in their ability to find ways to still generate profit and increase employment growth, regardless of who's in office. And so it just hasn't made a ton of sense in the past to depend just on that as or when it comes to making investment decisions.
Okay. Well, the good news is we have a lot of interest here. We've got a ton of questions. That's also the bad news because we can't get to all of them today. I'm going to have one more question, and then we're going to make sure that we follow up with everybody who has asked a question here to answer your question. So one more question, and then we'll close out. And I think Blake is going to share, I think, the results of the poll. One more question. There's a lot of projected layoffs from airlines and other large companies coming down the pike in October. Do you anticipate another drop in the market like we saw in March because of all those layoffs?
That's a great question, and I think that what the answer hinges upon is the election outcome. You know, so the layoffs are going to happen. A lot of them have been announced for October. I think what in part what the answer hinges upon is what the post-election stimulus measures may be, and they vary pretty widely based on candidate. I think we would see potentially a likely infrastructure plan from Biden if he's elected, although it appears that Trump is less and less likely to provide a round 2 of stimulus. And so all that being said, our belief, Krista, is that these are going to be, even though they can add up to very large numbers, how big the numbers they'll add up to will still not even come close to how severe it was in March. I mean, because it's going to happen on an isolated company by company basis, as opposed to saying the entire economy is in shutdown mode for a period of 6 to 8 weeks, which we just foresee not happening again. And so with that being said, that's why we think the worst of the data is behind us. But to prevent it from getting much worse, we think that there needs to be some level of additional stimulus. And what that ends up looking like will depend on, frankly, on who's elected and whether or not or when the vaccine comes forward and is made widely available.
Okay. Thank you, Tim, so much for your insight and for your time today. Folks, that concludes our webinar for today. Blake is showing the poll results. We had an initial poll result, and then he reopened it. So these are additional respondents. So that is just a small selection of the total amount of people that actually joined. I wanted to let you know that the video of this will be available on the CWT website in the ebook library. So if you want to look at it again, or if you know people who might want to view this webinar, please take a look in the ebook library. On a personal note, I know that many of you are stressed right now. There are a lot of things that are not in our control. That said, the one thing that experience has shown us is that even in the bumpiest of times, we know how to manage portfolios and guide our clients appropriately. We're all in this together. Thank you so much, and we'll talk soon.